you gonna do, fiat dollar? Or CryptoBullGod and his crypto maniacs and the entire cryptocurrency market run wild on you?
Welcome in. I am the CryptoBullGod, and this is the recorded on Thursday, airing on Thursday, March 10th, 2022, 30th episode. Wow, I've done 30 of these things. That's insane. 30th episode of the CryptoBullGod, or should I say CBG Podcast. You can find me on Twitter, Tradingview, YouTube, and Instagram at CryptoBullGod. So I am back in South Florida. For those who are subscribed to the channel, you can tell when the background looks a little different. I must not be within the same establishment. So I've been up in northern Florida there for, I don't even know, I think it was 6 weeks or approximately. So I am back in South Florida. It feels weird being back down here since I haven't been here in a while. You know, the place I go to daily is the gym. So I was back at my local gym here and saw one of my good buddies today. Shout out to you, my friend. So it was good to see him. And so no, it feels real good to be back in the South Florida heat with all the crazy drivers out there cutting you off and no turn signals. Shit, it feels good to be back. No, it's nice though. It's good. It's good. You know, one of the things I wanted to mention, I feel like life in general has been busy, but more to come at a later date. But time is going to be a little bit tight between now and May. I have a few things going on, and I'll share at some point what that is. I'll elaborate, but I will do my best to get content out there on a consistent basis. So just bear with me, please. But as always, if you appreciate the content, please drop a like, leave a comment, and subscribe to the channel. You know, no matter how many times I say that, I kind of have to chuckle to myself because whether it is my significant other or a family member, you know, I'll say drop a like, leave a comment, subscribe to the channel, and I don't even think they do that. I think they're subscribed to the channel, but it does help the YouTube algorithm. So just keep that in mind. A little comment goes a long way and a like. So, but speaking of time, and as I was saying, being short on time, you know, I have to express one of my pet peeves that I ran into this morning at work, and I'm curious, I really would be curious, if anybody here, drop a comment if you have the same pet peeve, or I'd be curious to hear if you have just like a general pet peeve at work, like if you work in an office environment or whatever environment you work in. So the long and short is, we're working with a third-party vendor at the moment for some services. And this vendor sent us 3 questions, right? 3 questions, but they wanted to schedule a meeting to discuss the questions. Now, these questions could have been answered. We could have replied within 24 to 48 hours. It took a week and a half to schedule the meeting. We had the meeting, and I answered the questions the way I would have in an email format. And the 30-minute scheduled meeting that took a week and a half to figure out, we were on the phone for 10 minutes. Talk about a waste of time. Now, I am someone who politely and professionally will speak up if I sort of feel like something inefficient is occurring within the communication process. So I did say, hey, you know, just as an FYI, it may be more efficient from a timing perspective if you emailed us the questions. We could respond. You know, I feel confident we could respond within a day or two. And if there's anything ambiguous or there's some confusion or something isn't clear, we could at that point schedule some time for a call. Oh, yeah. Oh, that sounds good. When your day is busy as it is and you have a lot of things going on, the last thing you want are meetings to pop up on your calendar that are just inefficient, worthless, and could have been handled within an email in 10 minutes, right? So I'm all about efficiency. Like, let's just utilize the most effective form of communication possible. One other thing I wanted to point out for today before we get into the main topic for today's conversation I did release a YouTube video today that was just a few different clips from some recent TA videos that really helped to put in perspective my view of things moving forward. And really what the video, it's a short video, it's like 5 minutes. But what the video encapsulates and what it summarizes essentially is, it summarizes my view of things moving forward, but what it encapsulates is what my view is and what I'm helping to try to spread awareness on from an educational and logical perspective to keep people grounded, because there's a lot of emotion out there right now. A lot of people get caught up in this day-to-day BS. So it's really just trying to help everybody to stay grounded. So if you haven't, check out that TA video. It was just dropped today on March 10th. It's just called Perspective. It's 5 minutes. Feel free to leave any comments regarding, what your thoughts are on that video. But let's get into the main topic of today's conversation, which is inflation. Interestingly enough, for those who have been here for a little while and have been paying attention, I have mentioned a few times that, and actually it's in my intro video on YouTube, that my profession is I'm an actuary. Okay, I'm actually a life actuary. So you can Google what actuary is, but an actuary is they're referred to as numbers people. Okay, very analytically minded individuals, right? So one of the things that we do, one of the things I really appreciate about the way management runs monthly meetings that we do with actuarial staff is they provide us with an opportunity to lead discussions. So we have a monthly actuarial team meeting. And I will team, in this case, there are two people paired, so I teamed up with someone. And we rotate every month between different people. And myself and a work colleague, last month were responsible for coordinating and running the meeting. And one of the things we can do is we can pick the agenda of what we want to talk about. So I'll give you an example. So now most people who run these meetings, they have guest speakers come in, they have people talk about actuarial subjects. My train of thought is, look, all day we're doing nothing but actuarial science, right? So let's get outside the bubble of actuarial science and let's learn about something else that's interesting and relevant, meaningful to people's lives, right? So last year when I led that discussion, I actually did a 30-minute presentation on the GameStop gamma squeeze that was going on because I thought that was quite interesting. And this year, the topic that I thought a lot of people would appreciate was inflation. So my perspective is I work with a lot of brilliant people, a lot of intelligent people. There's a lot of people I work with who are more gifted and intelligent than I, for sure. However, with that being said, coming into the meeting, kind of exercising some common sense and intuition, a lot of people, just because they're very gifted and intelligent, they kind of have a craft, right? In this case, actuarial science. So they're laser focused on that. And then maybe they have a family. And so any outside time outside of work is spent on the family. They just don't have the time and resources, or maybe they have downtime and they just want to relax, to kind of go into depth on subject matters outside of actuarial science. And specifically, the subject I was looking at was inflation. And my train of thought was that you could have a room full of very intelligent individuals, but it does not necessarily mean that they're very well versed in the subject matter of inflation. And as I quickly discovered, as much as I felt that I did know, once I delved deeper down the rabbit hole of CPI and how inflation is measured, I learned a lot of things. And that's really what I want to share with you today, because this is relevant to cryptocurrencies. This is very relevant to cryptocurrencies. So I'm actually going to run through the presentation, maybe at a higher level and in a different tone that I did with the actuarial audience, but I want to run through and I really want to try to educate you on inflation, what CPI is, and to really get a good understanding of how it's impacting us. How is it being measured? What's true real world inflation? all sorts of things encompassing inflation. So if you appreciate the content as I'm going through, please drop a comment, leave a like, and subscribe to the channel. So I think the first thing to really understand here that's very important is we need to have a basic understanding of what inflation is. So inflation, just simply defined, very simplistic definition, is just the purchasing power of US dollars decreasing, which is reflected by the increase of prices of goods and services. So meaning it takes more dollar bills today to purchase the same item from yesterday. So a good example would be chicken wings, right? I remember way back in the day going to a place to purchase chicken wings, and they were like 10 cents for a chicken wing. So an example of inflation, maybe back in the year 2000, going to a place where it costed 10 cents. For that same chicken wing, same ingredients, same store, in 2022, 22 years later, the price increases for that chicken wing from 10 cents all the way up to 70 cents. So it's gone up 700%. It's not that anything about the chicken wing has changed. It's just the cost of goods and services going into it have become more, quote unquote, expensive. It just takes more dollar bills to purchase those chicken wings. So that's a great example. The same chicken wing in 2000 costed 10 cents and now it's 70 cents. So then what causes inflation? Well, there's a lot of different factors, and an economist could bore you to death going over all the different factors that impact inflation. Of course, there's a lot of supply constraints going on that are impacting inflation. But the one I really want to focus on, okay, and the one that kind of brings us home to Bitcoin and cryptocurrencies, I want to talk about the printing of US dollars, because there's been a tremendous amount of printing of US dollars, unlike anything that we've ever seen before. It's very important to understand that the US dollar is a fiat currency. And in fact, all world currencies are fiat in nature. So what does that actually mean? Well, a fiat currency is simply a government-issued medium of exchange, backed by nothing besides government officials. So, in other words, government officials have full control over the supply, and the supply is not fixed on anything. So the implication of this is that there's an unlimited supply of US dollars, okay? There is a quote that's out there from Herbert Hoover, our former president, in 1933, and it's interesting how often we forget history. He said we have gold because we cannot trust governments. The US dollar used to be backed 100% by gold. What that did is, because it was pegged to gold, and essentially a dollar was a certificate representing gold, you could exchange one for one, the dollar with an amount of gold. What the gold did is it created a fixed supply, okay? And then eventually what happened was we went on something called the Bretton Woods system, which was a partial backing by gold, and then we eventually just went totally off of the gold standard, and we literally had US dollars that were backed by nothing. Again, backed by nothing but people in charge who could decide they could just print infinite amounts into supply to increase the supply of the dollars. Basic law of economics. If the supply of something, if you have a currency where the supply is increasing drastically in value, it becomes worth less and less and less because there's more and more of it available, okay? If you actually look at how many dollars were printed during the beer virus situation back in March of 2020, what it resulted in, if you look at a graph of the total assets that are held by major central banks, and let's focus on the Federal Reserve within the United States, you'll see that 80% of US dollars have been printed in just the past roughly 22 months. Okay, and this is maybe a month or two old that I'm speaking to. So we can still use that statistic, though, because it's still fairly close to that. So 80% of US dollars have been printed in the past 22 months. I want you to think about that. For every $1, 80 cents of that $1 was created into existence in the past 22 months. So the supply has increased drastically in value. Okay, so one of the questions that you might be asking yourself, if the supply of money is increasing at such a rapid rate and that could lead to inflation. Well, why hasn't inflation just readily, right after that happened in March of 2020, why didn't that appear within the economy? Well, there's something called the velocity of money. And the velocity of money is the rate at which money is exchanged in an economy. Meaning, in other words, how many times the US dollar is being bought and sold between two entities. So what it means for inflation is that it takes time for the money to materialize in the economy via buy-sell transactions. So for example, when the government decided that they needed to bail out cruise lines and people and just send everybody stimulus checks, even if they didn't need it, by the way, and they just decided, we're going to print like $9 trillion. And they just create all this money and they disseminate it. What happens is they create the money, they disseminate it to institutions, people, but then it takes time for those entities, people or institutions, to transact with the money and start buying and selling goods and services. So it takes time, the velocity of money, it takes time for the appearance of these dollars to work its way into the system and create inflation. And again, the concept is as more dollars enter the system, it takes more dollars to buy the same thing. There's more availability of the dollar, and so it becomes worth less and less and less. So one of the things that should be on your mind regarding inflation, and this is why I decided to kind of put this presentation together for today and speak to it, is the CPI, or the Consumer Price Index, was just reported today, and it came in at 7.9%. Okay, but what is the CPI? Really, we need to understand what it is, who measures it, how it's calculated. So, in general, the Consumer Price Index contains several major categories within a basket of goods, okay? It contains food, clothing, housing, medical care, transportation, education, recreation, and the miscellaneous. Now, those are looks like 8 or 9 broad categories, right? But there's all these different things that are in this basket of goods. Now, what we need to understand is what specifically is included in it. How is the distribution of these goods and services determined? How are changes calculated? Okay, has the calculation methodology for CPI changed over time? What does CPI impact and who calculates the CPI? This, as a statistician or as an actuary, are general questions that I would ask when I'm looking at the calculation of anything, and anyone should really ask themselves. Okay, so first off, the Bureau of Labor Statistics, the BLS, is the entity that's responsible for calculating the CPI. And one of the things that's very important to understand about the Consumer Price Index is that there have been several important methodology changes that have occurred over the years. And we really need to understand what the difference is between a cost of goods index versus a cost of living index. So a cost of goods index, which is, by the way, the way I thought it was calculated prior to doing research. This is how I thought it was calculated. Cost of good index measures inflation looking at a fixed basket of goods and services. This is literally how I thought it was calculated. Intuitively, it makes sense. Cost of living index measures inflation with the intent to reflect changes in the cost to maintain a constant standard of living. Okay? So there's cost of goods index, which is a static, fixed basket of goods and services. And then there's cost of living index, where it sounds like there's some subjectivity there. We're measuring inflation with the intent to reflect the cost to maintain a constant standard of living. Okay, let's explore this a little further. Well, cost of goods and services is how it used to be measured, and cost of living index is how it's currently measured. So let's take an example where under the COGI method, cost of goods index, let's say hand soap increased from $1 to $1.10. Filet mignon increased from $20 to $22. And a computer, the cost increased from $1,000 to $1,100. And let's say these 3 items was the total basket of what you were looking at for CPI. Well, all 3 items under the cost of goods index, if we look at this, all 3 items increased by 10%. So in this case, your inflation rate would be reflected as 10%. But let's look at this hypothetical example, and let's calculate this under the cost of living index to see how the calculations differ. Again, this is a hypothetical example to illustrate the methodology differences between the two and why you can't compare them when looking at CPI. So cost of living index. Let's say that J&J hand soap went from $1 to $1.10, but the generic costs $1, year over year. Well, we're saying here that the inflation is 0% because what we're saying is the consumer, to keep their cost constant at $1, J&J increased by 10% from $1 to $1.10, but consumers can switch to generic. Okay, they can switch to generic and pay $1, which is the same cost they paid last year. So we're going to call that 0%. Filet mignon still went up 10% from 20 to 22, but guess what? Chicken only costs 20. So consumers are going to say, screw filet mignon. I'm going to switch over to chicken because it costs the same this year as filet mignon did last year. So inflation is 0%. This is a funny one. Computers increased from 1,000 to 1,100. Well, that's a 10% increase, right? Well, no, not really, because there were quality of improvements made to computer chips within the computer. Because of that, we're negating the 10% increase and saying because of the quality improvement, there's no inflation. That's fucking crazy. So really, your total inflation under this same example for cost of living index is 0. So we went from 10% to 0%. As you can see, the cost of living index methodology interjects a lot of questionable subjectivity. There's substitutions that are made. There's quality improvements reflected. Also, the other thing to keep in mind with cost of living index is that the cost of buying a home has been removed. Lumber prices have been ridiculous. There are so many costs associated with home ownership and buying a home that are very high in value. None of those things are being captured within the current CPI calculation. The other thing to keep in mind is that this calculation is recalibrated every 2 years. So whatever's being included within the basket of goods, that's recalibrated every 2 years. So the other thing to keep in mind before we go on to asking the question of why does CPI matter and who does it impact, it's very important that if you understand what it is that I'm saying, the cost of goods index I think the cost of goods index was used up until sometime in the 80s. Don't quote me on that, but I think the 80s, and then we switched over to the cost of living index. Because the methodology differences are so different, drastically different, you can't put up a graph. It's not fair to put up a graph and graph CPI over the past 40 years because you're comparing apples and oranges because of the methodology differences. You'd really have to do something called normalization. You'd have to normalize the methodologies. You'd have to put things on an apples to apples basis and either recalculate in years past the cost of goods indexed based on the cost of living index, or you'd have to calculate when we made the change to the cost of living index, you'd have to calculate those years based on the cost of goods index to graph it on the same graph for the past 40 years. You can't take two different methodology calculations and put them on the same graph because you're looking at two very different calculations and you're comparing apples and oranges. So drop a comment if that didn't make sense, but hopefully that makes sense. So why does CPI matter? Why does the consumer price index matter, and who does it impact? Well, the CPI is going to impact Social Security payments, which are a government payment or obligation. So meaning if the CPI increases, so do Social Security payments. National debt, which is a government obligation, and GDP. It's going to impact the national debt and GDP. Tax brackets, which are government receipts. So for example, this is a really important one. So for example, over 10 years, let's say that your income goes up twice as much as when you started, right? So let's say you went from $50,000 a year of income to $100,000 a year of income. What's going to happen is you're going to enter a higher tax bracket. So you're going to be handing over to the government more money of what you're making. But what we're saying is over those 10 years, based on real world inflation, if your purchasing power hasn't increased at all because of the cost and goods of services have increased drastically around you to outpace your income that has gone up, what's happened is your purchasing power hasn't gone up at all, even though you're making more money. You have the same purchasing power, but now because you're making twice as much income, you're actually being taxed more. So it's like a double whammy. You have the same purchasing power 10 years later, but you're now in a higher tax bracket and forking over more money to the government, so you're actually making less. This is crazy. Let that sink in. Income goes up twice as much. You're being taxed more, but you're like, well, I'm making twice as much, so like I can buy more. Nope, because of real world inflation and the way things have gone up around you, your purchasing power is the same. So you're actually making less money 10 years later. Let that one sink in. So let's say, for example, if the CPI is being reported low and the government or the Bureau of Labor Statistics is underreporting inflation, let's say it's 2.5%. Well, first off, your Social Security payments are going to remain low. Okay, remember, that's a government obligation. They have to adjust Social Security payments to reflect CPI. If CPI is purposely, and I'm not a conspiracy theorist, but if it's purposely based on the subjectivities being utilized within the cost of living index methodology, if CPI is being underreported, the government is making out really well because they can pay lower Social Security payments. National debt, which is a government obligation, this is going to remain low, yet if real world inflation, again, is going up real high, you're actually paying back debt here with cheaper dollars. You need more dollars to pay down the debt because the dollar is being devalued by real world inflation. Tax brackets, I just explained. As your taxes increase, people lose purchasing power. You're paying more money over to the government as your purchasing power remains the same. So this seems like there could be a potential conflict of interest with government motivation and what is being reported with CPI. So one question you should ask yourself, a very important question, is how can you protect yourself? How can you protect yourself against inflation? This is funny. This kind of rattled somebody's brain within the meeting. This first one, this person reached out to me. So the first one is do not park. And it amazes me, again, because I work with such intelligent people. But again, it's like some of this is, there are certain things as you're growing up, as a child, as a young adult, that are ingrained in your head from your parents, right? You're raised a certain way to believe something, and things around you are changing, and you have to evolve your line of thinking. And if you don't, you can kind of get stuck within an old way of thinking and potentially lose out on things. So that's what number one is driving at. So the first way you can protect yourselves, don't park a substantial amount of capital in a low interest bearing savings or checking account. Think about it. Your rate of return minus your inflation, which is the spread, okay, your rate of return within that account minus inflation will be negative, so you're losing. Savers are losers. You have to invest your money to outpace inflation. Number two, invest, and this is what this gets at, invest in assets or investment vehicles where the rate of return is greater than inflation. You got to look at the spread. Your rate of return in these investments, minus any expense or commissions paid out, minus inflation, needs to be positive. Okay, that implies you're winning. If it's negative, you're losing. Purchase real estate. Real estate historically has been an awesome investment opportunity over the long term. You can look at your 30-year fixed rate and look at the spread between the appreciation percent, the fixed rate, and inflation to see if you're ultimately winning or losing in the end. And then also employment decisions. Okay, there are employment decisions you can make. I put this in the presentation. Think about this. I was at work, so it's kind of funny. The bullet here says, annual pay increases to match real world inflation. Ha ha ha. Yeah, you're not going to work for any employer who's going to give you, let's say, real world inflation. Let's say for a moment you believe that the cost of living index and the associated subjectivity with the methodology is underreporting inflation. So today CPI was measured at 7.9%. Let's say you look at measurements that are not included within the cost of living index, and you would argue it's something closer to like 15%, okay? You're not going to find any employer out there annually who's going to increase your pay by 15, 10%, okay? It's just not going to happen, so it's kind of funny to think about. Performance bonuses and job promotions can help, okay? This can certainly help temporarily. You can also seek a new employer with a moderate to significant jump in pay. But again, this is something that's temporary. And then you can also have a side hustle, right? You can create a YouTube channel, call it CryptoBullGod, do some podcast and TA videos, maybe monetize the channel, get a little additional income on the side. So you could do a side hustle, but keep in mind, most of the things that I've pointed out within these employment decisions outside of the side hustle, these are temporary things. So it's really about being financially savvy with the capital that you have to invest it such that the spread is positive, meaning whatever you're investing in, when you look at the difference between that and inflation, you're outpacing it. That's really what you need to do so that you don't lose your purchasing power, okay? And then I just gave an example here of how your purchasing power can erode over time, even if you're getting, most employers here. So I'll just tell you what the punchline here is. I have a graph up on a PowerPoint you can't see. In year one, you're making $100,000. And every year, what I'm assuming is, and this is realistic, if your pay is increasing, okay, over 10 years, if your pay is increasing at a static figure of 2.5%, 2.5% is a very realistic, that's actually, full disclosure, that was what my pay increased by this year. A measly 2.5%. But I say measly 2.5%, but that's not a knock against my employer. They're keeping pace with what other employers are doing. I mean, most people get about 2.5%, 3% if you're lucky, pay increase. So if we assume you start in year one, you make $100,000 a year, your pay increase every year is 2.5%. If you agree with what I'm saying on the subjectivity of the cost of living index measurement, okay, and you believe that as a result, CPI is underreporting inflation, then let's just assume for the moment, let's assume a static amount over 10 years, that real world inflation, the things around you on average are increasing, I'm using here as an example, 10%, okay? And it's to illustrate the point, okay? I'm not saying 10% is realistic, but for the time being it is. So static over 10 years, your pay increase is 2.5%. Static over 10 years, real world inflation, everything around you that you pay for is increasing on average 10%. What it means is your spread or net adjustment is that your purchasing power, I put net annual pay / purchasing power is decreasing by 7.5%. What that means is by year 10, okay, at the end of year 10, your purchasing power erodes from $100,000 to $46,000. Really think about that. Now, for people who are not mathematically inclined, this is something that can be really challenging to comprehend. I get that. Thankfully, God blessed me on the left side of my brain. So for me, numbers come very natural to me. This makes total sense to me. But it can be very challenging for you to really conceptually think about the fact that if you're making $100,000, your purchasing power in year one is $100,000. Your purchasing power based on real world inflation and the little adjustments you get in pay can result in your purchasing power eroding by more than 50%. By the way, this example does not take into account any tax bracket changes that you might undergo to pay more taxes to the government that I spoke to earlier. So hopefully you found that presentation very interesting on CPI. I hope some of the things surrounding CPI make a lot more sense to you, and I articulated things very well. Again, just a broad overview to give you a better level of appreciation on what inflation is, how it impacts you, how quickly it takes to show up. What is CPI? How was it measured yesterday versus today? Is it underreporting or overreporting inflation? And then what can you do to protect yourself? So hopefully you really appreciated the content. So with that being said, let's get into the chart of the week. Man, I need some water here. I've been talking nonstop here rapidly. Ooh yeah. The chart of the week, actually coincidentally, I felt it would be really good to touch on this, would be the DXY chart. Something that I've hit on in a couple videos now and I tweet about is the inverse relationship that exists between the DXY and crypto. So historically, as the DXY, the US dollar currency index, has depreciated in value and gone down, cryptos have gone on a very big run, right? And I pointed to this price confluence, and you can follow me on Twitter at CryptoBullGod to visually see this, that I don't expect us to get above. Now, one of the things, and I felt this would be a good time to touch on this, is right now, Again, I'm looking at things on a monthly view. Right now, if we look at the March candlestick, it's above the point of confluence. And what I don't want people to do is to misconstrue what I'm saying here and what to take away from this. If you look at the blue circles on the chart I have out there on Twitter, go to the DXY or on any of the videos that I've spoken about it in the past on my TA videos, you will see that we have price wicks that go above that red descending line. At some point during the month, what that's telling you, what that's telling us is that price action during that month was above the red line of resistance, but ultimately closed below it. Okay? In order for this to be a true breakout, in order for my hypothesis to be invalidated, March needs to close well above the red line of resistance, and then April and May need to see continued movement up towards 100 plus. Okay? I do not see that happening. We could still close a little bit above the red line of resistance, and it could be a fake out. We could get rejected and go back down below the red line of resistance, but the point is I don't want anyone to think 10 days into March, because there's a green candlestick above the red line of resistance, that this is going to continue to play up to the upside. I do not see that. Now, it's possible. It's possible. I could be wrong. I could be totally wrong. We could smash through. It could invalidate the price action that we've historically seen, the resistance since July of 2001. But I don't have a reason to believe that at the moment. So keep a close eye on the DXY. See how March closes out. And then see how April and May in particular close out. Will we get a fake out, a false breakout above the red line, reject and go back underneath? Or how's this thing going to close out from March? Let's keep a close eye. I've kind of indicated this before. It's one of the most important charts that you can be keeping an eye on is the DXY, and I would focus on the monthly. I would zoom out on that time frame. So now let's get into Twitter questions. And by the way, I do apologize because I gave very short notice on doing Twitter questions today, so I doubt that I have many questions. But let's check this out. Yes, only one question, but in all fairness, I just tweeted this out about 40 minutes ago, so literally right before I started recording. So the one question, which I'm going to like right now, Steve, who frequently interacts with me, thank you very much for the question, Steve. I've kind of spoken about this before, but let's revisit the subject because it's a very good question. So Steve says to me, basically, what are your thoughts on if we'll have a similar bear market like the last cycle when BTC tops? I think, until proven otherwise, it's very reasonable to assume that we'll see something similar. I do not believe for a second it's going to be exact. The market is maturing. Market structure is going to change and develop over time based on the market capitalization increasing. But what I would say, let me give you an example to put numbers on it, okay? Again, as a mathematician, I can appreciate putting some specific values on it, all right? I believe off the top of my head, during the last correction, Bitcoin corrected around 85%. Maybe it was like 83 or 85%. I think a deep correction, okay, and we're still very early on in things. I think a deep correction for something similar would be very reasonable, but it could be a little less than 85 or 83%, maybe because the market capitalization has increased quite a bit. Maybe we're looking at something like a 78% correction. But in general, what I would say is you're saying similar, okay, not the same, similar. Yeah, I think the bear market will be similar, okay? Yeah, for reasons I've pointed out in my perspective video, my TA video that I released today, all the highlights from prior TA videos. No, we're not in a bear market. We're still in a bull cycle, getting some bearish short-term price action, but we're still building higher highs and higher lows. So it hasn't invalidated my view on this still being bullish structure and the ascending triangle I've pointed out, et cetera, et cetera. But yes, when we enter a true crypto winter, a true crypto bear market, I believe we will see something similar. And the reason I'm saying that is because we only have past history to go off of. So until something different happens, I don't have any reason to believe that we'll see something different. So that is my view. Thank you very much for the question. I really hope you appreciated the content today. It is related to cryptocurrency. We really focused on the CPI, Consumer Price Index. Drop a comment. Click that like button and subscribe to the channel if you're not already. So, as always, in closing, on this 30th episode of the CBG Podcast, please join me in a moment of silence For all of those, I attempted on multiple occasions to get into crypto and have remained ignorant. Thank you.